Order, order. Welcome to the Treasury Select Committee on Tuesday the 14th of July 2026. We're here today to consider the Bank of England's Financial Stability Report, one of our regular sessions with the Governor. I'm delighted to welcome Andrew Bailey, the Governor of the Bank of England, who's joined by from my left to right, Randall Crosner, who's an external member of the Financial Policy Committee at the Bank, and Nathaniel Benjamin, who is Executive Director for Financial Stability and Strategy and Risk at the Bank of England, and Stephen Blythe, who's another external member of the Financial Policy Committee at the Bank. Governor, if I could just start with you. You told us when we spoke to you in January that the risks of financial stability had increased in 2025 for the obvious reasons, all the geopolitical events that we've all witnessed. Do you think they've increased further since then?
Yes. For a number of reasons, actually. But I'll pick out two. One is obviously developments in the world economy, and particularly developments in the Gulf and the Middle East conflict, which I don't think actually directly increases the sort of structural issues that we've identified in the past, but obviously increases the risk of things crystallizing, and also I think increases the impact when were things to crystallize. So that's the first thing. The second thing, which I have written to you about in the last week, is I would say is the big new development, which is the news on frontier AI and the cyber risk consequences of that. So I think, unfortunately, it's a sort of unambiguous yes to your question.
Well, we'll come to AI in more detail later. Now, obviously, the conflict in the Middle East, we keep having a ceasefire, and then it's not a ceasefire. What's your prediction for how that's going to impact the long-term situation in the UK economy?
Well, if you'd asked me this question a week ago, I'd have probably given you a slightly different answer. I'd have said a week ago, look, actually things, if you go back to the hearing we had on monetary policy a few weeks ago, I think I would have said, look, I think things are panning out at that stage, probably at the lower end of the three scenarios that we had painted in the MPR. But I would have added the very strong caveat to that it seems to me that the situation remained unstable, and the sort of the ceasefire was fragile. Sadly, that's come to pass, obviously. I think where I am now, for the moment, is that obviously that as I say, that instability has come to pass. I don't certainly feel qualified to judge how long this is going to go on for in terms of this resumption of hostilities and how it's going to end. But it underlines that this is going to be an unstable process for the foreseeable future. Now, energy prices have come down. As of a week ago, they were sitting a bit above where they were before the crisis. They're now somewhat further above, but they're still obviously. Crude oil prices are well down on their peak. We are also seeing, I think, continued fairly soft evidence on the pass-through into UK prices, but we'll get another inflation number next week. The one, however, other caveat I would add, which I don't think gets enough coverage, is that although crude oil prices have come down, the prices of refined products have not come down as much. So we're talking about things like gasoline and diesel at this point, which of course are the end products. So those are the things that matter in terms of the end products. And one or two of the reasons for that in the global context are that there's a story around China and obviously a story around Russia. China has substantially reduced its imports of crude over the last couple of months. That's been interpreted, therefore, as a sort of softening of the market and a sort of reduced demand story. But they've also, as far as we can tell, reduced their exports of refined products substantially. So in a sense, actually, they haven't necessarily changed their balance, and that is tightening the market in the global market for refined products. And the other thing, of course, obviously, and this is obviously, good news in other respects, that obviously Russia's had a serious blow to its production capacity from what Ukraine has done. So I would make that caveat that we all spend all our time quoting crude oil prices, but you have to be a bit careful because I don't think refined product prices have come down as much.
And one of the challenges, of course, is the damage to the infrastructure in the Middle East, which can take 8 months minimum to get once there is a ceasefire that holds, it's going to get things back on track. What modelling is the bank doing to look at the impact on the UK economy in the short to medium term?
Well, I mean, we obviously talk a lot to people in the industry, and we obviously talk a lot to our counterparts in the Gulf area. Right? So I spend a lot of time talking to my counterparts. I think the story there is, take oil and gas separately. On the oil front, there hasn't been as much physical damage to the infrastructure, the supply production infrastructure. Obviously, the blockages in the Gulf are another matter. So I think the message we get from the Gulf states is that if they can ship the stuff out, then they will resume production very rapidly, and they have well, at least up until last week, they had resumed production rapidly. They are also have got quite big plans, which they're already executing, for building new pipelines to get round the Strait of Hormuz, to get it to ports which are south of the Strait. But that will obviously take some time to do. On gas, I think the story, certainly the story we get from the Qataris, who are the people who matter, obviously, in that market, are, I mean, they're quite precise. I think they say about 80. I think they say about, if I remember rightly, about 83% of the supply is intact. The 17% that was hit by the Iranians in the attack some months ago now will take longer to bring back. They again too have got quite big plans for increasing their overall output of gas, but that again they're talking about sort of 2029, 2030, I think, for that. So I say they're clearly very determined to get supply back onto the market, but obviously what we're seeing in the Strait now is going to impact that.
Okay, so it's a rocky period ahead. I'll come to some of the witnesses on that in a moment, but we're about to have our 7th Prime Minister in 10 years. We've had a lot of change at the top there, so we're talking about internationally, but domestically, though, do you think those changes and all that upheaval is good for financial stability?
Well, I'm not going to comment on obviously on what's happening in politics.
Well, I mean, I suppose, let me say
two
about the
things.
stability point.
No, but two things which are important. One, as the last few days have demonstrated, the big driver of moves in financial markets is actually not what happens in the UK. It's global. It's the global setting. What I would say, however, is that I think what the evidence does indicate is that the UK situation is sort of supported by, on our side, obviously, monetary stability and financial stability, and I think on the other side is the fiscal framework. And obviously, you did see a bit of movement in markets briefly on the fiscal, on news on the fiscal framework, but that came back quite quickly.
If you were to be, you can't give private advice to us in public, but we've got a new Prime Minister, a new government, a refreshed government, I suppose you could say, coming in next week. What would be your top tips in order to make sure that we have financial stability, or their best chance of maintaining financial stability in the UK?
Well, I think that the overall message I would give is that I think the big issue is growth in the economy. So I think we can do all we can on financial stability, and we'll come on to this no doubt. I do actually think there are signs of a very resilient financial system. We described them in the financial stability report, and in two respects. One is, I think for instance, the core banking system is resilient, and I'm sure we'll come on to discuss that. But also, when you look at debt levels in the economy, if you look at debt levels in both the household sector and the corporate sector, I mean, they are not stretched actually at the moment. So that's that gives us an underlying picture of resilience. What I think is much more challenging is that we've had low growth in the economy now for best part of probably 16, 17 years actually. This is not a story about any one government, by the way. This is a general story. It's not a political story in that sense, but it is a story about UK growth. I've made a number of speeches recently on this subject. I think it's important because it's the critical structural issue. And as far as I will, in a sense, go into fiscal policy, which is not far, what I have said is, look, it is interesting that if we did a simple, naive sort of counterfactual and said, imagine that we'd had the growth rate for the last 17 years that we had for the preceding period, which was a potential and actual growth rate of around 2.5% a year. So we've been around 1.5 for the last 17. So imagine you add that 1% back in. you've got the same shocks. So you have exactly the same fiscal policy for every government, not changing fiscal policy. You've got the same shocks: COVID, Brexit, Ukraine, Gulf. They all happen. Where would we be, naively, where would we be today on debt, on the public sector debt level? It would be about, I think that number was about 10 percentage points lower. Now, therefore, you haven't sort of solved all problems, but I would argue, I think it would be a very different debate.
Okay, that's very helpful. And one of the there was a strong drive here in the UK for deregulation of the banking sector to promote growth. And you know, when we meet with those financial institutions, they're keen to see that and constantly stress that we're a long way from 2008.
Yeah.
Do you think that emphasis on deregulation and growth pose a risk for financial stability? Because sometimes that's the tension that's put to us by other people, that the bank is holding back growth because you don't want to see that deregulation. Is that a fair comment?
My overall view on this is we will not get growth if we don't have financial stability. I mean, I think we can point to episodes in history which support that view. So financial stability and monetary stability are key underpinnings of growth. Does that mean, however, that every one of our rules in financial regulation is perfectly formed? No. I mean, it doesn't. Would that ever be the case? No, because the world always moves on. So do we support a process of review? Yes. I do think that where I do differ from some of the arguments that are put is, let's take the banking system, because it's important. You know, the key to actually the banking system supporting the economy is to have a system that is earning returns which more than cover its cost of capital, which means that they can invest their returns to support lending into the economy, and that is the best system we can have. I think after a long period of rebuilding capital in the banking system post the financial crisis, we actually are now in that situation. They earn more than their return on capital, and you can see that in the market numbers. You can see it in the price-to-book ratios. Therefore, it seems to me they have a choice they can make as to whether they reinvest earnings into their own business or they pay them back to shareholders, and that's a choice that should be made in the market. We were not in that position before. The reason I push back is that some of the debate I find, and you read the debate, it's as if we've got this sort of fixed amount of bank capital, and therefore we must sort of lighten regulation to allow it to sort of be spread around further. And it isn't fixed. It isn't fixed at all. I mean, I'd say a healthy banking system will earn its returns, and they can be reinvested into the economy.
Okay, well, they've heard that. Mr. Krosner, from your perspective, let's take the look at the Fed. Does a wash-less Fed mean... What's it mean really for financial stability globally and in the UK? Do you think there's going to be any changes as a result?
So Kevin Warsh and I went through our confirmation hearing together and to join the Fed, and we sat next to each other for years during the global financial crisis. So he has been battle tested in financial stability, and he's very aware of and sensitive to those issues. So I'm obviously no one can guarantee that there will not be a financial crisis, but he is aware of and very sensitive to those issues. Obviously, there's a lot of change in financial regulation in the U.S., and a new proposal related to the Basel III endgame, which I think is providing much more effective regulation. And I think it's very important not to confuse effective regulation with deregulation. We want to make sure that regulations are effective, that they reach the financial stability goals, but also that banks can intermediate, that they can actually do lending, they can do what they're supposed to do in the economy. And I think that's the key motivation for what's going on at the Fed now in thinking about financial regulation. And I think from the more macro perspective, Kevin is going to be very much aware of those issues, is not going to want to do anything that is going to expose the time that he is at the Fed to a financial crisis. But of course, sometimes events overtake what one wants, and certainly when I was at the Fed, I had studied a lot about the 1930s. Ben Bernanke had said a lot about the 1930s. I don't think any of us thought we would be in a 30s-like crisis, but having studied that period, that was very helpful, and I think Kevin, as well as others who have been through that period, will make sure that we're best prepared and will be able to respond to try to minimize the damage if there is some sort of shock that causes a crisis.
Thank you, that's very helpful from someone who's so close to Mr. Walsh. Jim Dixon.
Thank you, Dame Meg. Just looking at other risks that we're facing at the moment, we're just at the end of or sort of in the middle of the third wave of extreme weather of this year. So clearly climate change is sort of front and centre for all of us on thinking about the way in which the country and the world is developing. Would you say that climate change is now a bigger risk than you'd previously estimated? I think when the Governor came to us previously, you said it was sort of one of a number of risks, obviously, but it had slightly receded in terms of the extent to which it was something that you had as one of our primary risks. Would you say the recent focus on climate change has changed your view on that at all?
Well, I was making a relative point. Wasn't making a point about the absolute level of climate risk. I was making a relative point. I'm going back to the Chair's first question. To me, given what we've seen on, for instance, on frontier AI over the last few months, I sort of have to make that point again. I mean, look, I'm not a climate scientist myself, so I'm not going to venture an opinion on what we can conclude from what we've seen in the last few weeks. But we've obviously had Europe has had a very strong period of very hot weather. I think it does remind us that there are very clear risks from climate. Yeah.
And either the Governor or other members of the panel, does the sort of climate change we're seeing, does it impact on financial institutions in a way that we should be taking notice of? Would anyone want to, Mr. Benjamin, perhaps?
So the channels in which climate change affect financial stability haven't changed. They remain very present. They are risk to banks, they are risk to insurers, and they are risk to core markets from climate change. This hasn't changed, and part of our analysis is to gradually embed this analysis into the mainstream of how we test financial stability.
And we've still got sort of strong teams of staff at the bank looking at those issues and understanding the analysis that you're talking about. Because I think the Governor, last time we spoke, you said there were now, and you accepted there were now fewer staff perhaps working on those issues, and that might indicate a sort of a kind of lesser emphasis on them, which was perhaps a bit concerning.
No, again, I'll make this point. We have to actually, allocate our resources to reflect sort of the relative risks as well. And for instance, AI has come up the league table very rapidly.
We'll come on to AI momentarily. Catherine West, MP.
Thank you very much, Dame Meg. On the point of AI, what assessment has the bank done on the needs around water, particularly internationally, thinking of countries like Malaysia, where it's such a big part of the economy now, but the physical needs around water, etc., that will, if not handled correctly, could have an impact on economic stability. What assessment?
I'm not sure. I'm not sure we're the experts on that one particularly, to be honest.
Mr. Benjamin.
There's one aspect.
It's always good to have an expert in your organisation.
I'm not an expert either, but there is one aspect in which, and it is related to AI, in which the availability of water supply does affect those developments. It is we've all heard about the very large increases in the infrastructure of data centers that are being planned to develop AI capabilities. Those large data centers will require water supply in order to cool down the production line. The needs for water are large from that, and one of the questions are whether the water infrastructure will be sufficient to meet the needs for those developments at the pace that is currently embedded in the expectations of the markets.
What assessment has the Bank of England done on the demand on the grid for AI in the UK, and what impact that might have on financial stability? If certain infrastructure projects don't go ahead, but AI is demanding that...
Yeah, can I make 2 points? I mean, I think it comes back to this question of growth. So if, and I do subscribe to this view that, because I do think technology, I made this point about lower growth over the last sort of 17 years. I do think technology is part of this, because I think in the long run, technology is one of the drivers of growth. I think we'd probably be globally been somewhat between sort of technology cycles. So we had the internet cycle, internet ICT cycle. I think the next cycle is likely to be some combination of AI and robotics. So I think this question about, grid capacity and data center capacity is relevant here in terms of supporting growth. The other point I make, actually, and this is a point I have to be honest, I'm not, not being an expert in this field, I hadn't appreciated until going around the country and talking to people who are closer to this, that there is also a question of what's called access to clean power supply. Now, I'm using clean in a slightly different context to the environmental point here. It's actually the quality of the power supply. In other words, the sort of having a sort of very high quality and very continuous power supply. Some people have made the point to me, and I think this is on their own at the moment. Renewables don't on their own give that clean power supply. They can be a big part of it, but they don't completely solve that problem. You need a base load of other power to make sure you've got that clean power supply. So again, I think in thinking of, and that's true for data centers. So I think thinking about that, then I think there does need to be thinking about how you ensure that we've got that mix of power supply.
Thank you very much. John Glenn MP.
Yes, can I turn to the decision to ease the leverage ratio by 0.2 percentage points? I want to try and understand the range of views that exist on this, because I understand that it appears to be a split decision, and the quote is, most judge that the benefits of the proposed changes outweigh the costs. It would be useful to understand what the range of views were, and how meaningful that range is in terms of decisions. We start with you, Governor.
Yes, I'm happy to do that. Just to put it into context, I mean, I think the announcements we've made on the leverage ratio are, in my view, really about sort of cleaning up some of the issues around the leverage ratio. There was a particular issue where we'd made some changes back in 2019, which I think had created an anomaly, which was particularly affecting the large domestic banks. And that's important because they are the people who make, the highest proportion of loans into the UK economy, and it had left them facing a higher leverage requirement than was I think justified. So I think cleaning that point up was important. We have also, I think, increased the buffer usability in the leverage ratio, which I think also is important because it's exactly consistent with how we operate the risk-weighted ratio. Now, the one thing I would say is, of course, the risk-weighted regime and the leverage regime are not additive; they're parallel.
Yep.
That's important. So, we'd made some changes to the risk-weighted regime when we were here, and we talked about them in December.
Yep.
These are changes in the sort of the parallel regime. Now, the question, though, is this. So I think those things, for me, those things were all sensible things to do. The challenge we've got, and this is why there's some quite important words in the announcement, which I'll come to, is that we've got an issue with leverage in another context, which is leverage in financial markets. We've talked about this, I think, at previous hearings in the context of particularly of government debt markets. What we've seen in the period since the last hearing and in recent months is also a growth in leverage in equity market leverage. So in hedge fund leverage in equity markets, also in leverage in exchange traded funds. So there's a further growth in that world. Now it's all leverage, but it's a different context for leverage. But these two things are connected in the sense that the banking system is the ultimate sort of provider of liquidity, and therefore there are exposures between these parts of the system. So I think the question that for me, the question that we rightly debated at length in the committee was: is the better way, if we think we need to do something in that market leverage regime, is it better to do it in the banking world or in the market world? Is it better to tackle this market leverage question in the market sort of regulation world, if you like, or in the banking regulation world? Now, my own view, it's a personal view, I think it's better to do it in the market world, but we've got to land that because we've put out some ideas, got mixed responses, I'm not surprised. But you'll see that, final thing I'll say, you'll see that we've included some language which actually means we're going to do a bit of further work before we finalise these changes, which is exactly to this point. And it's particularly to say, do we think these changes might actually increase the market leverage risk? And frankly, the additional question will be, if so, but it's a question we've already got, what are we going to do about it in the market leverage world? Or do we do something in the banking leverage world? So I think there's sensible changes to make, though it's in their own right, but we have got this outstanding question about what we do about market leverage.
Okay, so who can help me understand what slightly complementary view to that is amongst the witnesses this morning.
Mr. Blythe.
Yeah.
Thank you.
So, I mean, I think the aim of the change to the leverage ratio framework to fix this idiosyncrasy that was the result of an increase in the countercyclical buffer in 2019. There was an offset in the risk-weighted stack of capital. There was an increase in the countercyclical leverage buffer. There was not an offset in the leverage stack. So that was a discrepancy, and that disproportionately affected the domestically systemically important banks. So I think there was unanimity on the committee that that was something to fix, and that's what's been achieved by this package. There's also a broad view that we want to be getting the overall balance of the risk-weighted capital requirements and the leverage capital requirements correct. The other view is that in addition to fixing the discrepancy for the DSIBs, the domestic, which makes a lot of sense and will support lending into the UK economy, there's also a slight reduction in leverage ratio requirements for some other institutions, and that could potentially lead to further provision of leverage into markets. So that's the question about cost and benefit. To the governor's point, I agree that there are mechanisms within the markets, in particular haircuts or margining on repo, that would actually be, I think, very effective for providing stability in markets that can be, in some ways, arbitrarily levered if you have no haircut on a repo transaction. And the leverage ratio won't fix that if you have essentially no haircuts on a repo. That's arbitrary leverage. So that's that was the balance in my view of the view.
Yes, thank you. So we had an excellent discussion that I think got us to a very good outcome. Exactly as the governor and Stephen have said, key motivation was to sort of make the leverage ratio more effective and make sure that it's doing what we want it to do, which is to prevent excess leverage in the banking system. But I also believe that this is not the right tool to try to deal with market leverage. Things like haircuts or potentially centrally cleared transactions are the best way to try to deal with that. And so I think that what we were doing is trying to make sure that we had a lot of things that could be released in a crisis. Getting back to the previous question, that's a very effective way to try to make sure that banks can continue to intermediate during a crisis and provide both support in the crisis and more rapid recovery. And so a 20 basis point change in the leverage ratio does not seem to be material to me in changing the ability of banks to either provide leverage more broadly, just within the domestic economy, or more broadly, and we have much better targeted instruments. So making the capital stack, much more of the capital stack, releasable, that also is something that is very helpful in achieving not only the financial, we obviously have our main objective being financial stability, but also in providing support for a secondary objective on credit provision and growth, because that's something that will allow the banks potentially to reduce the so-called management buffer that they hold above and beyond the required minima. Now, of course, they're always going to hold something beyond that. They shouldn't be running right at the edge. But when there's a lack of predictability, when there's a lack of clarity about what is releasable, how much it has to be rebuilt, how that's going to operate, that leads them to hold a bigger buffer against that. And I think the approach that we've taken will help to reduce that. So make the leverage ratio more effective without in any way affecting the from my perspective, affecting financial stability, and not addressing the market risk issues, which we'll do through separate means.
Can I just come on to the decision about lowering the capital requirement from 14% of risk-weighted assets to 13%? Because I think there are two broad set of views there. There are those that obviously think that this is where does the benefit go in terms of to the banks or and their shareholders, or to the economy as a whole. But there's also, I think, still significant dissent amongst many banks over what is the actual net effect of this, because there are so many caveats that the notional 13% is never met because of all the different elements that go into it. And people then say, well, if you look at the bolder measures made in the US, we are not really getting to, there's still quite a margin between where we are in the consequence of this change and what is actually happening in other environments. How do you respond to those observations?
Well, I would disagree that the US has taken bolder measures. I don't think they have, actually. I mean, the latest package they've announced is to implement Basel 3.1, which obviously we're doing as well. We've published a number of comparisons. We've actually, in the latest numbers, compared the leverage ratio comparisons. The leverage ratio is actually higher for international banks. So I would disagree on that point that the US has done bolder things. Actually, I'd say the same about the euro area. I don't think they've done anything bolder than we have. Let me make 2 points. I think I just the first one is just to reinforce what Randy said, which is we know that banks maintain what they so-called management buffers above our requirements. And as Randy rightly said, there are reasons for doing that, which will be about how they run their businesses, and that's understandable. But I think what we've done is it will enable them to have more confidence to reduce those buffers, and certainly that's our aim. But second point, we actually included a diagram in the publication we made. We would like to see the buffer structure simplified. So if we're talking about bold things to do, it is too complicated at the moment. We would like, frankly, a single buffer and a single releasable buffer. The reason I think releasability is important is that the thing that I think banks always worry about, if we don't release buffers, and if we say to them, look, it's okay to go into your buffers, we won't get upset. They always come back and say, well, will you? So the stronger, they always say, look, the stronger thing is if you're prepared when conditions change to take the buffer away, I accept that there'll be a rebuilding process at some point further down the line. That's a stronger message. So we'd like to see that. And we'd like to see it simplified so there's only one of them. To do that, we need international agreement. The buffers are a product of the international structure, the Basel structure. Essentially, we are, and Sam Woods, when he was obviously with us, made speeches on this subject. We've been leaders in advocating that. We will keep working to get an international consensus to tackle the buffers. We're not quite there at the moment, but I think that's the bold thing that should be done, and to say we're strong supporters of doing it.
But when banks look at what their effective situation is, they tell us that they never get to that amount because of all of those add-ins and overlays that actually occur. And so whilst I understand the aspiration to simplify and have a single buffer, if you like, the reality is that because of their hesitancy around the implications of not doing this in the right way, they don't, and the net effect is they end up holding more than they feel they ought to. And that is a persistent narrative that they bring to us, and members of this committee have had that drummed into them at private meetings recently. So I mean, you present a very sort of smooth and clear version of where you'd like to go. But the bottom line is, operationally, it isn't working like that right now.
Can I just let's take that. Let's sort of pick that argument apart for a moment. Why do they say that? Well, there are at least three reasons I can think of. One, we've already covered, which is that they maintain so-called management buffers above what we require. That is their choice. But I recognise there are things that we can do to simplify the structure which might assist them to maintain smaller management buffers. I think they'll always have them, but they will have smaller ones. Randy touched on this. And I think what we've done is steps in that direction. But as I was just saying, I think the big step in that direction would be to move to the single buffer if we can get international agreement. That's the first thing. The second thing is, look, capital requirements will differ from bank to bank, partly because of what the business they do. And partly, I'm afraid, sometimes because they fail to demonstrate to us, the characteristics of running the business that we expect. So we do sometimes put add-ons in. This is in the PRA's world more than.
Can you give an example of that?
Well, yeah, if they show that they can't manage risk adequately, our supervisors can put on.
And that is an active.
Yes,
that happens.
Yeah.
Right. Okay.
The
So
other
we
thing
should go back to the banks and.
Yes.
And okay.
Yeah. That's doing our job.
Look forward to having them. For
I'm sorry,
Mr. Benjamin's nodding. I wonder if Mr. Crossness, who's been.
Get your act together.
They also good risk management. If they're not doing good risk management, they're not acting appropriately.
Absolutely. I mean, they can also get higher capital requirements bank by bank because, for instance, they have greater concentrations of risk in particular activities. That's, again, a reflection of the risk they're taking. So that's the second point. And then the third point is sort of the fundamental one. I think many of them still think that 13 is too high. Now, I want to come back to points I made actually early on to the chair's question. We will have a strong banking system, and they will earn strong returns if they are, well capitalised, they are lending into a strong economy, and they are earning the returns. Now, I think the evidence is that they are in a strong position. I mean, there are a lot of complaints, frankly, about how much they're earning. Yeah. I've said, look, they have to earn their cost of capital. They are doing that, actually doing somewhat more than that. That's a sign of their resilience. So, the capital system does support their resilience. I mean, they will never say that to you. I'm afraid the odds of us getting them ever to say that, no, it's not going to happen. But I'm afraid it is a fact. They are supported by that. If they have weak capital, they will not be supported in that sense.
But what it feels like to them is that there'll be a move forward in one area, and then, for example, Sam Woods did not include the exclusion of unencumbered gilts when looking at the regional, leverage ratio denominator.
But that's not in Basel. No, Basel does not. Nobody does that. The US doesn't do that. I mean, excluding gilts from the leverage ratio, I know they'd like it, but frankly, that's not in Basel. It would be contrary to Basel, and nobody does that.
Thank you very much, Mr.
Did Mr. Crosno, did you want to come in? You look like you were getting
So
animated.
I think this is one of the reasons why we have stress tests to and make sure that they do have appropriate risk management. And most banks do pass a stress test now. So it's not we're setting a barrier or a hurdle that is so high that is unattainable that no one can get an A in the class. Now most of the banks are getting an A in that, so they know how to achieve that. And I think it's completely appropriate that if they are taking undue risks, then they should have add-ons. Yeah. If they have processes in place and sufficient capital and appropriate risk management, then they are free from that.
But the fact that major UK institutions have an effective requirement closer to 14.25% rather than 13% in reality is really just a function of them not operationalising risk management appropriately.
Well, it will come down when Basel 3.1. I mean, part of this is that Basel 3.1 will reduce that. Because remember, when we went,
it's work in progress.
When we went from 14, look, when we went from 14 to 13, we were actually marrying up top down and bottom up. The FPC does top down, PRA does bottom up. The bottom up element is coming down, consistent with 14 to 13, and a good part of that is Basel 3.1, and that's why the FPC felt it was sensible to match the top down.
Could I ask you, Mr. Crosno, about this? What the banks tell us about the apparent gap with the US that the governor pushed back on. I mean, what some of them have said to us is that the UK banks now face a 190 base point capital premium compared to the US competitors. Now, you can dispute the quantum of that, but do you recognise anything like that, or any meaningful difference between the US and the UK?
Many different ways to calculate those sorts of comparisons.
Yeah, and that's how you sort of get out of jail on this subject.
Yes. And also, one of the challenges also is that just accounting is very different for like what are considered bank assets, and so that becomes a challenge to do the international comparisons. I think we've been trying to undertake a review to and obviously what we put into our reports is looking at international comparisons. The UK is a major global financial center, and it has to be competitive. And I think we very much take that into account. I'm very cognizant of that and bring that into the discussions. But then when we get into the specifics, where there's 190 basis points or minus 10 basis points, that becomes a bit more of an art than a science.
Do you think we'll ever get to a point where it will be apples and apples, and you can make a reasonable comparison, and we'll stop receiving all these representations from the banks?
It might be worth, Nat may want to come in, because we published, obviously, in December, a detailed, I think the most detailed comparison. Yeah. You've looked at the feedback that we've had, which is where they make these points to us.
That's right, and there has been a range of feedback coming from absolutely different sides, so I think the fact is that with the package we have now set out, this brings in line UK capital requirements with requirements in other jurisdictions, and in a way that is consistent with the analysis that we did and consistent with the feedback we received on this point. I think the other point to note is often US banks, so I used to supervise US banks, the US banks also hold internal management buffer above their regulatory requirement, actually much more than some of the UK banks, and yet that doesn't have a detriment to their earnings or their profitability. And there's a sort of a
just very briefly. We also hear this in the US, the international comparisons. The US banks always feel that they are being unfairly gold-plated. So I think it's a natural thing for domestic banks to go to their domestic regulator and say, look at the others, they get away with this, we don't get away with it. So I think we'd hear a very similar thing if you were sitting in the US Congress.
Sounds like managing teenagers, but perhaps that's a bit flippant.
No comment on that.
Yeah, sorry, yes.
Can I just ask one more question around the net effect of this in terms of to the banks and the bank shareholders, or to the economy as a whole? And in terms of the narrative that they bring to us is that if they can actually get access to more money to lend to grow the economy, yet we see our banks doing quite well in these circumstances. Yes. Do you have any views then on how we should review the performance of banks financially and the impact on the economy and what they do with the freedom they've got?
Well, let me come back to what I said at the beginning. I do push back at this, what I sometimes call sort of lump of capital argument that goes on, which is this idea that they've got a fixed amount of capital, and if only we'd lighten the regulatory regimes, they could sort of lend more out, support the economy, and everything would be good. Because there isn't a lump of capital. I mean, the fact is they earn their earnings. They then have a decision to take about how much of their earnings they frankly distribute to their shareholders and how much they retain to grow the business. And obviously that's a process that they have to go through with their shareholders. Now, I recognise we went through a period up until only about 2 or 3 years ago, after the financial crisis, where they were not earning their cost of capital, and it was very hard to go to the shareholders and say, you should leave this money in the business because it's a good thing. Because the shareholders say, well, no, it's actually not a good thing because you're not earning the cost of capital. I can take it somewhere else and find somebody who is. But that's not true anymore. They are more than earning their cost of capital. And the best illustration of that is the price to book ratios. They're now, I think, on average about 1.7, whereas they were below 1. So 1 is the sort of obviously the point where they're at cost of capital. So they're not in that position. So they can. I think they are resilient. That's why, as we talked about stress tests, they pass stress tests. They can make choices now, and the choice they can make is to support lending into the economy. With those earnings, and that's what, to my mind, they should be doing. And a resilient system will support that, and it will support the economy.
I'm just going to bring Mr. Blythe, I think, wants to come in, and we do need to wrap this section up because we could spend forever discussing capital and bank, and I'll bring in Mr. Coughlin.
Thank you. I just wanted to bring attention to that we've published the feedback from a very broad consultation about this matter, and not only from banks, but from academics, from rating agencies, from bank analysts and bank investors. And I think that is a very rich picture, and I think it's clear that banks will, all things being equal, prefer to have less capital and less requirements. I mean, any investor or risk taker would like that. And I think that what we heard from academics and bank analysts in particular is their arguments that the capital should be higher, and actually bringing it down is not the right thing to do. So I think this is quite a balanced a balanced argument, and from rating agencies and bank investors saying, well, we look carefully at the capital people are holding, and we want to make sure that's appropriate in order to invest in these banks. And I don't think their view is that the back capital levels should be going down.
That's very helpful. Chris Coughlin, one brief question.
Sure. Governor, you sound slightly sceptical about the bank's position on this. Of course, prior to 2008, banks are making the exact same argument that you need to just deregulate, lower capital requirements, all be fine, the economy will go gangbusters, and in the process they blow up the global economy. To what extent does that history inform your thinking now?
Well, it does a lot, actually. So, I mean, I'm realistic enough to know that the memories of the financial crisis are now disappearing sort of into rearview mirrors. Some of us, probably all of us, probably have, unfortunately, undying memories of it, having had to deal with it. But they are disappearing, and so you have seen this in history before. You get these cycles, and I think we are seeing this, where people are now saying, the response to the financial crisis was too great and too strong. It didn't feel like that at the time, I have to tell you, when we were dealing with a system that was extremely weak and having to rebuild it. I get people saying, but you've solved that problem, you should move on. And you say, well, yes, in the sense that I think the system is now resilient, it's rebuilt, but the idea that we therefore sort of relax the standards because it's all over, no, that's not the way it works. So, I'm philosophical. This is a debate we have. And I just come back to this point. I'm not against, saying I'm not going to defend all our rules as perfect. They're not. But the central point is we will not have a strong economy without financial stability.
Thank you very much indeed. I'm actually going to move on because we could go on forever discussing this, but we do have other topics. And on the subject of AI, which we parked at the beginning, Governor, I'm going to bring in Bobby Dean.
Thank you, Chair. Yeah, Governor, I'd like to return to something you made a point out of highlighting in your opening remarks, which is about the sort of heightened risks around frontier AI. Yeah. I think critics will say, I told you so, when the discussion started talking about AI a few years ago, and it was kind of levelled down as another risk to manage, and now you're saying that it's grown much faster than you anticipated. So what is it that you didn't foresee previously?
Well, it's not just us. If you talk to the people who run, Anthropic, OpenAI, they will tell you that the advance that they've seen in these models in the course of the last months has been much faster than they expected. They draw these sort of what I call exponential curves, and they're saying we've now moved into this vertical sort of part of the exponential curve in terms of the advances of these models. So, they too were taken by surprise. So if you take Mythos, which was the Anthropic model, which really sort of kicked this off back in April, really. And I've talked to Dario Amodi about this. They were surprised by the advances this model made. And when I talk about that, the reason is that these models actually they are self-learning. They do this sort of recursive learning process. So it's the speed and effectiveness and the ability of these models has moved dramatically forward. And so when they're subjected to the sorts of tests that the AI Security Institute in the UK, which is, by the way, absolutely world leading on this, subjects them to when they test the models. And they say how effectively and how quickly are these models solving and real world problems that they're given. It's moved on dramatically in terms of A, what they can do, and B, the speed at which they can do it.
I think we can all accept that the reality has moved on much more quickly, but we obviously had an inquiry into AI financial services, and I feel that we heard evidence about the potential advances in AI and how they felt that the financial service sector was perhaps underprepared for the potential movements. Now, the fact that it's happened more quickly than anticipated is one thing. But one of the things we heard from lots of regulators at the time was that actually our existing risk frameworks are fine. We can be technology agnostic. Do you still hold that?
Well, I think, can I say, I think there's two things here that we can, and they need to, they're both related to AI, but they need to be sort of kept separate. So on Frontier, we're talking about cyber, very specifically. And to use a sort of sports analogy for a moment, Frontier AI will strengthen the defense and the offense. So if you're the defense, if you're us, if you're the banks, firms, you can put Frontier AI to work to strengthen, because it will find the flaws that have been buried in there for a long time sometimes, and you can fix them. unfortunately, if the offence gets hold of it, they will do the same thing to attack you. And obviously, the whole thing at the moment is can we make sure that the defence gets strengthened, effectively before the offence, and that's getting much more challenging. The second thing, which I think you're referring to, is equally important, but this is how banks use AI. So we're not talking about cyber here, we're talking about how they use it and the risks that come with that. That's equally important, and I think your report was very helpful and very good in this respect. We are very actively engaged on that subject too. I think banks are, I think my sense is, we're all using AI a lot more. I mean, that's a truism, but the banks are using it a lot more. Where I think it's still more talk than actuality is things like agentic trading systems, setting up your own agents. And I think that's right, because I think there are some very big questions still to be answered about how that world actually would work. For instance, I mean, the one thing, I'm not a lawyer, but the thing that strikes me is if you have an agentic trading system as a bank, and going back to Frontier AI for a moment, I mean, what Frontier AI demonstrates is that the recursive learning capacity of these systems means that they actually develop their own abilities. And as my colleague Sarah Breeden has said, but we don't invent this. We get this from the firms who are developing it. They learn to cheat and they learn to lie. I'm sad to say. Where do they learn that from? Well, it's partly inherent in them, and partly because they're trained on a data of past experiences, and they cover things up. Now, if you've established an agent, you've got to be very clear where the legal liability rests in all of this. So I think there are things that will need to be resolved before that world really develops.
Mr. Benjamin, if I could turn to you, and we might want to continue with the Governor's World Cup analogy about attack v defence. What are firms' current access to these frontier models? Presumably they're on the defensive side of this equation. So how is their defence?
So I mean, the financial sector generally has been putting a lot of focus on these things, and what is happening at the moment is firms are in the process of testing those type of capabilities on their own system. So the big risk that comes with frontier AI development is the speed at which weaknesses in IT estates can be identified, and therefore what that means for patching and the speed at which software upgrades need to be made. So this is the work that is happening. Andrew mentioned earlier things that give the edge to the attackers versus things that give the edge to the defenders. One of the key aspects is the speed at which those capabilities become accessible to the attackers. They are typically accessible before to the defenders. So this buys them time, in a sense, to identify those weaknesses, those vulnerabilities, and to prepare for much faster patching. Because another risk is that the moments when software are upgraded are also the moments where there are greater risk of disruption, of IT disruptions internally, not because of an attack, but because of the effect of the upgrade itself. So this is the work that is happening within the banks and within large firms at the moment to get them prepared to this new state of the world.
We've been talking about risks in the abstract. Could you describe to us what the impact would be if, say, the attack got there first? To a standard financial firm institution, if there was...
Well, there are two ways cyber tends to manifest itself. One is those who want to disrupt systems, and then often there's a blackmail effectively, and then the other is stealing information. Those are the two things that can go on. And as Nat was saying, I mean, what we're finding, or what is being found, is that flaws that have existed in very core pieces of software in the world. And this, by the way, I mean, the financial systems are just a subset of this. Obviously, it goes across the whole shooting match, as it were, that have often been there for a very long time, can be discovered by these systems and can be discovered quite quickly. Now, I mean, I think the people who know much more about this than I do, I think at the moment, going back to the football analogy for a moment, it requires a lot for an offensive party to set this stuff up to do this. It's not, you don't, by the way, go home and get Mythos, plug it in, and off you go. It's rather more than that. But this is the second issue that we've got. As I said, we're now on this vertical exponential curve, they say, so that these models have a shelf life of only about 2 or 3 months now, actually, and then they're replaced by something even more powerful. I know that if you talk to the firms, the developing firms, they say there are going to be open source versions of these things coming onto access, which will mean that it's much harder to restrict access to them. And then let's be honest, where are other regimes in terms of developing their own? And obviously China is the big case there. They may be some months behind, but they're not that far behind.
I want to bring in Mr. John Grady just for one quick
briefly, Governor, you mentioned legal responsibility for agentic models. I'm a recovering lawyer. Is the bank, and do you think we are clear about who is responsible if, for instance, financial institution A uses an agentic model and it starts cheating and lying and, as you described briefly, because I don't want to derail the whole hearing?
Well, I'm not a lawyer, so let me. So I think it would be good to. I mean, and we are certainly doing this to get to also get the views of the legal world on this. But here's my understanding. Let's go back to sort of basic principal agent law. Mm-hmm. If I'm the principal, you're the agent. You're my agent. I think in the traditional sense, I give you a remit to act on my behalf. I am liable for what you do when you dispense my remit. If you go outside my remit and start doing other things, you're liable. That works, of course, when you and I are both legal persona. In other words, you could be held legally liable, I could be held legally liable. But obviously with an agentic AI model, that doesn't work because you're not a legal persona. It's not a legal persona. Now, I think, it's normally the case that in that case, so let's get going. The agent does something outside the remit. The principal is liable where the agent's not a persona, I think. Well, if that's but I don't think, this hasn't been tested much in the AI world. But let's say that is the case, then I think the principals, the banks, let's say, are going to have to think very carefully about, obviously, therefore, how they manage the use of agentic AI. Because if they're going to be responsible for everything it does, and if there's this issue that it can go off-piste, then they've got to think that through before they start using this stuff.
The whole can of worms.
And I think it'd be useful once
that's the limits of my knowledge, I have to be honest with you.
To come back to us in writing on that important point.
We do, Nappy.
Yeah, of course, there's the third parties that are involved in it as well, the AI companies and some of the major tech companies as well in terms of this. I mean, if we move on to a slightly separate point, which is the critical third parties regime, and I think there will be 4 brought into the regime now. A concern that's been raised has been how much oversight you're actually able to have over these firms when they're kind of quite opaque about the technologies that they hold. Mr. Benjamin, I don't know if in your capacity, what is your relationship with these providers and how much do you get to look inside their black boxes to understand what the real risks are?
The regime is coming in place now, and our colleagues on the PRA will be the ones supervising them. So that is going to begin, and we needed the regime to be in place first before coming into that.
Are there these general concerns about working with these providers and how much information they're willing to share about their systems in order to be able to understand them?
No, I mean, if you're referencing the 4 that have been nominated, no, I wouldn't say there are concerns at all. I mean, we've had relationships with them, we've had discussions with them just for broader reasons in the past, and they're very open to those type of discussions. So I'm not worried about that.
I guess my point is more about regulatory capacity. Though. I'm sure they're going to appear to be very open and willing to cooperate. But does the bank have the staff, the knowledge, the know-how to be able to properly hold all their systems to account?
Mr. Benjamin.
So we have our colleagues in the PRA have entire divisions of people who are specialists of operation resilience and who are well versed in these technical topics.
Mr. Dean.
Okay, I'm going to move on to a slightly different threat that's still related to AI, and perhaps Mr. Blythe, you can speak to us about this, which is growing concerns about the threat of an AI bubble and the impacts that could have. The easy comparison is that of the dot-com bubble. Are the risks similar or worse?
I mean, it's a good comparison in terms of the level of concentration and heightened valuations, and I think, especially in equity markets, I think there are a number of elements here. First is that the continued growth in or increase in equity valuations, especially in AI stocks, has been coincident with very strong earnings. But the current valuations are predicated on a very optimistic future earnings path. So it's not clear that it's necessarily a bubble, but it is, in our estimation and the bank's estimation, based on quite an optimistic path going forward. So if earnings aren't realized along that optimistic path, then there could be a significant repricing of AI equities.
On that point, can I put to you, I think it was JP Morgan's report where they said something like $650 billion worth of revenue per year would be needed to get a reasonable return. And they also remarked on some of the sort of physical limitations in ever being able to achieve that kind of revenue because of, we talked about water supply earlier and data centres and other sort of physical infrastructure. Is that something you recognise? Do you think that actually, as things stand, the returns required are actually physically impossible to get at?
I wouldn't say they're physically impossible, but we're very cognizant of the risk, both power, cooling that we've mentioned before, planning, actually being able to actually get approval to build data centers. All these things are risks to a positive earnings story. And I think from a financial stability question, there are two elements that are particularly concerning and on the radar. One is that the funding for a lot of AI expansion is now going form in debt form rather than equity form or from cash flow. So that you can see from some of the data, the growth in 2026 has been extreme, and obviously debt, if there's a popping of the bubble, can have a lot more impactful downside. And the second is there's a lot more leverage, which we mentioned before, but leverage on the long side in AI equities, and that's both institutional and retail, and that's both of those can be concerning. So institutionally, a lot of levered funds, hedge funds, have been taking long positions in AI equities, often funded either in derivative form or funded by prime brokerage. And then on the retail side, a lot of levered ETFs. So this means if there's a fall in equity prices, then that can lead to a negative spiral. So I think from a financial stability point of view, market volatility is not per se a financial stability concern, but when it can be amplified rather than contained, then it does. And I think those risks are growing on the AI side.
And that change towards heightened leverage positions has happened very quickly, it seems, over the last year or so. We've got information about Alphabet's position, for example. Does that make you feel that a potential bubble burst is much closer than it was this time last year?
Again, it's hard to predict, but I do think that the impact of a bubble burst would be more significant given that leverage. I mean, the pace of change of leverage is remarkable. I mean, the data that we see on the prime brokerage increase, that's remarkable. Levered ETFs, the pace of growth in that is remarkable. It's not as big as in the prime brokerage, but that pace and the pace of increase in debt issuance is extraordinary. And so there are many things we'd be thinking about. One is this crowding out other debt issuance because there's so much debt issuance coming in AI? Is this actually now just increasing this leverage long to the AI story across the financial system? And if that levered long to the AI story across the financial system means greater interlinkages when the bubble bursts. So hard to say about the probability of a valuation reset.
Can I just ask you about the UK's specific position in relation to this? Because obviously we don't have so many developed AI firms, but we'll still be exposed to any impact. And there's kind of two sides of the coin, really. One is the risks of that bubble bursting and what that means for the UK. But also, in the meantime, what's it doing to our growth prospects if so much capital is going in one direction?
Well, I mean, as you say, even if there was a bursting of a bubble which is primarily not located in the UK, the market effect is so large now that it clearly would wash over. So I think that's right. And of course, we ran a stress exercise which looked just at this question, and it did reduce UK growth. Now, exactly how the effects would run through, you would expect obviously some adjustment in UK macroeconomic policy, which is another way of saying, you might expect some adjustment in interest rates to reflect that. So how you play it through, you'd have to decide. But yes, it would wash over. On the UK growth side, I mean, let me start by adding 2 points to what Stephen was so interestingly saying, because I think there's two other issues here on how can this go wrong. One is history would tell us with these big general purpose technology innovations that it takes longer for them to come through into productivity and growth than people think. Now, this one may be a lot quicker because the pace, as we were saying, the pace of change in AI is clearly accelerated a lot. But you know, you go back to something like Edison inventing electricity, it took a lot longer. You go back to ICT, the famous Bob Solow comment, you know, you can see computers everywhere except in the productivity series. And that's really one way of saying it takes time for these things to come through. The second thing is everybody is currently priced to win. Everybody sort of doesn't win in history. If you can remember the first company that actually got the biggest share of internet browsing, it wasn't Google, it was Netscape. So, you know,
dates us all. Well,
sorry?
Dates us all, Governor. Those of us who remember that.
Yeah, I'm sorry. That's me. I don't know. In terms of the UK, I mean, I think it's important. First of all, you know, this is obviously a highly globalised market for these things. I think the UK does have real advantages in this area. I mean, I think there are real you know, centres of expertise. I think we've got a university system that is a very strong, you know, producer of very strong you know, research and outputs. I think we have, I think, a very encouraging state of affairs at the moment on tech startups. I mean, Patrick Vallance was saying to me the other day, I think we've got the most ever in this country. I think the persistent question is actually the next stage. You're much more experienced than I am. Is how you go from startup to scale up. And that's an issue that remains a big issue in this country.
John Grady MP. You want to come in or not? Okay, that's fine. Okay, so Chris Coughlin MP. Okay, fine. Yuan Yang.
Thank you, Chair.
Somebody on if you like. Governor of the Bank. Okay, Yuan, over to you.
Thank you, Chair. Mr. Bailey, I want to go back to your comments about leverage in the gilt markets and the issues there. The Financial Times reported earlier this month that there had been new reforms announced this month to the management of the gilt markets, in particular to the use of haircuts. In particular to the use of haircuts.
Yes.
Are those reforms still planned to be announced this month, or what is the timeline?
And we obviously put out, as we do, we put out a discussion document. Yes. I mean, we've obviously done a lot of analysis. We ran the system-wide exploratory scenario. From that, our conclusion was that rather than sort of what I call sort of classic regulation in the institutional sense, of the financial institutional sense, we thought there were areas where, you know, market regulation, and particularly, as you said, in these areas such as clearing for gilt repo, would be sensible. I think it's fair to say that we got a mixed bag of responses. We were not surprised because obviously there's a whole set of different interests at play in this. So I wasn't at all surprised by that. We are currently going through working out what to make of that, and we will come out with proposals. Do you want to?
That's right. I mean, part of the responses we had was, I mean, clearly, clearing is happening. Clearing of repo is happening in the US. And a natural question from us, well, you know, it is happening in the US. Is any reason why it can't happen in the UK? That's the question we posed. The feedback we got was that there were differences in the structure of the UK sovereign debt markets that weren't present in the US. So we're reviewing and reflecting on that feedback carefully. But I would say the option of doing nothing on that front isn't really an option. It's important. Markets have been much more resilient than they used to be. That is a good thing. We've gone through a lot of shocks. That is a very positive thing. But that resilience has to be locked into the structure of those markets.
Yeah.
If I could make one really big point here, and it's not a point that necessarily sits easily, but we've seen, obviously, we've said before, fundamental change in market structure in recent years. But by the way, in other government debt markets as well, so the UK is not alone in this respect. It has enabled, I would argue, a lot more government debt to be issued. Let's be honest. But it's created a more leveraged and arguably fragile market structure as a result. So we've got to come to terms with all aspects of this, frankly, because there are some difficult issues in there.
And what is the timeline, Mr. Benjamin, for those future reforms to be
We're in the process of evaluating the feedback, reflecting on the feedback we received. We will provide an update on our thinking here as part of our Q4 financial stability report. So that is the next step.
And that will be an update on the thinking rather than the announcement of new measures. So
These things will take time.
Okay. So in the discussion paper you mentioned before on September 2025, enhancing the resilience of the gilt repo market, you launched that in collaboration with other agencies such as the DMO and the FCA and the Treasury, and also the market participants, because of course management of the gilt market falls between all of those different agencies. So do you plan in drawing out those reforms, in setting out those reforms, to continue working in that collaborative manner? How will you consult with those agencies? Mr. Benjamin.
We're working together with these colleagues on an ongoing basis. This is not a new thing, and those are issues we discuss very collaboratively with our colleagues in other agencies.
Yeah. So will it be a kind of combined decision of those agencies, or will it be a bank decision? How does that?
Well, ultimately, in terms of who has the power to implement specific decisions, this will depend on the nature of the measures, but these will be things we discuss together.
Yeah. I mean, I hope we can come to a consensus on it.
Okay. Great. And I want to go to the most controversial of the measures, which is the haircut on gilt repo, which Mr. Blythe, you mentioned earlier, I think. Am I right in thinking that you're on the pro side of such a measure?
Well, I mean, I think I mentioned actually in my hearing when you were appointing me that when I've traded a lot of repo and traded a lot on the buy side, and obviously all things being equal, I'd rather have no haircut and be able to get unlimited leverage, but with a and I think I would speak for every hedge fund every hedge fund manager. Why would I? Because obviously that if there's even a small haircut, that might increase my cost marginally. However, from a financial stability point of view and in the round, I think it's a very important thing to be looking at that there's some minimum haircut on gilt repo seems to me entirely appropriate. I don't think that would impact actually on the functioning or the ability of the market to function appropriately and be resilient to shocks. So yes, I'd be on that side. Appropriately calibrated, of course, because yeah.
What would you say to your former colleagues who responded to your discussion paper saying that this might backfire because it may raise funding costs and reduce gilt market liquidity?
Yeah, I mean, I think that's a very effective lobbying argument, because anything that says, and I would obviously make that same argument were in that seat. However, I think we should not be...
Obviously an inspired appointment.
Obviously we should... I don't think we should be allowing unlimited leverage in the gilt market in order to maintain a certain level of levered hedge fund return. I mean, if one has slightly higher capital, that might mean that hedge fund returns are slightly lower. That does not mean that funding costs would go up. That does not mean the market is less liquid. It would just mean that hedge fund levered returns are slightly lower, and I think that's probably the right place for the cost in the system.
I mean, is a big concern here the lack of quantitative evidence on each side of this argument as outlined in the discussion paper?
I think it's certainly as the governor said, the market has shifted. The market structure for gilts has shifted, and in particular as the defined benefit pension funds have become less of a demand, and also as real money asset managers, insurance companies, etc., have bought their duration in gilt markets through futures. Yeah. So we have a particular structure. It doesn't just in the UK market and the US market, where the buyers of the cash gilts against the futures are hedge funds, and that's financed by this repo market. So we have a particular case here, but I don't think there's evidence that would be disrupted in any particular way by having an appropriately calibrated repo haircut.
In terms of quantitative evidence, we have very deliberately started to publish much more aggregate facts on the exposures and positions in core UK markets, so that market players can better use that information themselves for their own risk management and use that to be better prepared for shocks when they hit. So that is a complement to the system-wide stress test that we did. On your point about the cost of the minimum haircuts, I think part of the feedback we received, which is a valid point, is that the eventual costs to participants is not just based on just that one repo that is being done. It's based on all the trades that are being done by those players in the round. And usually the repo is only one part of a broader set of trades that are being done, for example, together with some futures or some derivatives. And it's important to look at the all-in cost rather than just the cost of a minimum haircut.
Thank you.
And Mr. Bailey, finally on this point, the chief economist at Handelsbanken has written a note describing that the underlying problem here is the loss of a stable investor base in gilts, and all of the issues that you're now seeing with leverage is one manifestation of the underlying problem. So is there work being done in the bank or across government to look at how to increase the domestic or retail participation in the UK gilt market?
Well, I mean, I think the issue there is, there's two parts to this. One, it's all about pension funds, but there's two parts to this. One, I mean, we have seen what I would call, because of the profile of the population, we've seen what I call a maturing of particularly of defined benefit pension funds. In other words, their age profile of them is coming to a point where they're not going to be natural buyers of longer dated government debt, which is why the DMO has reduced the duration of its issuance, because that natural source of demand, which actually was a very good thing, it was sustaining longer maturities and longer duration in the UK government debt market is naturally falling away. And you can't do anything, and that's a structural point. You can't sort of somehow replace that. It's a function of the population to a great extent. So that's the first point. And the second point is one obviously we've also discussed, I know, a number of times in the past, which is, and Mr. Glenn and I did a lot of work in the past on this, is of course we also want to see a greater share of pension fund investment going into the real economy. So we are, again, there's a number of big moving parts to this story. It has obviously resulted, so, but the UK is not alone in this respect, in a greater share of the purchases being done by what are more price-sensitive investors in the hedge fund world. I mean, the other thing I would say, of course, also is that the UK, of course, also has, and for a long time, has had a current account deficit, which means that there is a greater reliance. Overall, it's not you can't narrow it down particularly to one market, but there is a greater reliance on overseas investors in that sense.
Thank you very much, Ms. Young. John Grady.
Briefly, just to follow up on that, Governor, you mentioned that this has allowed more debt to be issued, but the market's more fragile. We've got debt to GDP of about 100%. Does that give you any concerns from a point of view of just the government being able to borrow in sufficient volumes, should it wish to, and the price of that borrowing? Do you think that's something that adds to those concerns? I think briefly, Governor, please.
I mean, 2 points. It underlines the points I made early on, to one of the chair's questions, which is on the question the chair asked me about UK politics, and I said, look, I'm not going to comment on UK politics, but a point I did make was that I think the fiscal framework and the fiscal rules, and again, it's not a point particularly about this government, it's been true in the previous cases, are an important underpinning of that. So I think you can see that in the response to the gilt market. You see in the response to the gilt market to the last budget, actually, which was favourable because there's a commitment to, in a sense, stabilising the debt ratio. So that's the first point. The fiscal rules are important in that sense. Now, the OBR, as you probably know, has published its, I think, one of its very helpful but not entirely reassuring structural fiscal outlooks, which is the long-term fiscal outlook, which obviously it does point to a situation which is going to mean there are more pressures. And I think we've got, at least 3 structural headwinds we're going against. One, and again, they're not unique to the UK by any means. One is, as I said, the ageing population, which I don't think gets enough consideration in this respect, and is going to go on because obviously that's baked in, as it were, and so to use an analogy. 2, obviously, another subject that's much in the news, the defence dividends, the post-Cold War defence dividend is over and it's turned around, and the third one we discussed earlier is climate change. Now, if you think about all of those, I always say, I think if we had one of those at any given moment in time, we would be saying, well, we've got this big issue to deal with. We've actually got 3 of them.
Thank you very much, Governor. Just moving on to market-based finance. Mr. Krosner, in your appointment hearing in January 2023, you told this committee that the data is just not there on private credit and market-based finance for non-bank sector. Do you think the system-wide exploratory scenario is answering that data question so that we better understand the riskiness of a non-bank sector of the UK's exposure?
I'm really glad that you asked that. I think this is an important first step. I don't think we have all of the data. We are making a lot of progress by doing something like the Suez. It really is world leading. Other countries are now doing things like that to try to gather this kind of data. The positive is that the market participants are excited about this because they're also getting data that they didn't have. This helps them to understand which trades might be very crowded, how correlation might come in a crisis or during pressure. And so that's how we get cooperation with these Suez exercises. So we're not there, but this is, I think, a very important step in the right direction.
And Mr. Benjamin, you want to come in, so...
Yes, I mean, if I can add, I mean, to run this point, we have had very good collaborative engagement on a voluntary basis from all the major players in the private market ecosystem, many of which are headquartered overseas. And through that engagement, we have obtained what is quite a unique data set on these exposures for the first time. So that is a very meaningful progress that we have here. And already we have published in our financial stability report what we found just as a result of that data set without yet applying the shock to it, which is very useful to have. So it's a first.
Is there anyone who hasn't participated in this on the market side, but you would have liked to have participated?
We have coverage of all the major players. Everyone has said yes.
And Mr. Blythe, just thinking about saves you to ask 2 exam questions, which I might be copying from the governor. 2 questions. Does everyone properly understand the interconnections between private credit and other parts of the system? And the second question is, do the people who own it understand the characteristic of the things they own? So far, with the progress made with this exercise, do you feel those kind of exam questions are getting closer to being answered?
Yeah, I mean, I've been really pleasantly impressed by the amount of, the amount of engagement, and to Randy's point, the large majority of capital providers and the asset managers and the capital providers are international. So this really has to be done on a voluntary basis, and the fact that there's a lot of willingness to, I think a lot of willingness participants is actually a testament to the credibility of the previous Suez and the credibility of the bank staff in carrying this out. So I've spoken to a number of people in the US in particular who are pretty interested in what we're doing. The question about do people understand the interlinkages between private credit and other markets, I think is still an open question. I think everybody in that market wants to understand those interlinkages. I think this exercise is doing a very good job of asking the questions, are you sure? I think some of the empirical evidence we saw with some of the bankruptcies, First Brands, etc., Trickler, and other events that have kind of resulted in, shall we say, unexpected losses at some of the banks is sort of re-raising that question that perhaps people don't understand those linkages as well as they could. And it's not entirely straightforward. I do think this Suez is a very important exercise to think about the interlinkages between, obviously, the ultimate capital providers, the asset managers, loans they may get from banks, the ultimate corporates, their relationships with banks, etc. Mapping that out is very useful.
Governor, I expect you to want to add something anyway, but do you think, given the growth in private markets compared to the banking sector over the last, say, 20 years, do you think we're all giving enough weight to this sector as opposed to having long conversations, rightly so, not criticism of John, Mr. Glenn, but about buffers and so on? Do you think we need to be actually shifting our weight to focusing on this sector more internationally with your colleagues?
I mean, so let me put my other hat on for a moment. I'll speak as chair of the Global Financial Stability Board for a moment. I mean, it's interesting when you look at the agenda of the FSB over, I don't know, the last 5 years, it has shifted substantially towards into the non-bank world, into this world we're now talking about. Much of our work is now in this world, and to your point, you were asking about data. Look, I think one of the big issues we've got to solve still, and we've got to a working group in the FSB, which I chair actually, which is seeking to do this, is to get cross-border data sharing on this whole market risk issue, because it's not as good as it needs to be. Because if you go back to the questions about hedge funds in the gilt market and the leverage, it's the same, tends to be the same big macro funds that are also leveraged in other government debt markets, and you will therefore get the risk of knock-ons across this. If we go back to what we were discussing about, with Stephen about margining, we saw last year some of the moments when we got the bigger movements in the gilt market was when we were getting margining requests coming in other markets. Because what we were talking here about initial margining, when we talk about sort of zero margining, the problem with that system is that if you have no sort of constant margining level, the margining from the models, from the risk models, becomes more pro-cyclical, because when volatility does come into the market, they start margin is demanded, but that's pro-cyclical. And we saw some signs last year, particularly during the tariff volatility, of knock-ons between markets going on. So the international issue is very important in this respect.
Thank you very much, Governor. Thank you, Dame Meg.
When you talk about risk, do you think that could, Governor, be a dysfunction in the gilt market completely, arising from a sudden correction in equity markets? I mean, how far do you think that risk could go and make it crystallised?
What I would say is this. We've obviously had volatility in the gilt market during the course of this year, caused by events mainly in the Gulf, and the market has been resilient to it. So we've had functioning markets throughout. We've had markets that have stood up and been resilient. So I think it's important not to be too sort of, in a sense, too negative on that front. But obviously, look, we've also had examples in the past where we have had volatility, and in one case where we had to intervene. And we've developed tools to deal with that, because we have to be ready for that.
You think you're ready for it?
Well, we've certainly got a lot more tools than we used to have, and we will use them if we have to. I hope we don't, but we will if we have to.
Benjamin, you ready for it?
Yes.
But that's great confidence. That's what. If you sit next to the boss, you've got to say that. Yes, let's hope
if I may, one point I wanted to add to the question of this pivot from banks to non-banks, to market-based finance. This has been very much reflected in the type of stress tests that we run. So we no longer just run stress tests as our banks and insurers. We start to run those market-wide stress tests, like the first was, now the private markets was, because of that shift in the provision of finance across the financial sector. Okay. But despite that shift, there's sometimes story that banks are no longer involved. That is not the case. Banks are still very involved, because they are by far the major providers of leverage to the non-bank world. That is the case for private markets, and it is the case for hedge funds. So they're still very involved.
Thank you.
Can I just add to Mr. Reedy's point? I think that balance, the balance between continue to focus on banks and looking at private markets is a very important one, because I would not want to hyper-correct into all this risk has gone out of the banking system. It has not. There is risk in private markets. It is less easy to get data. We are doing more work on that, but actually maintaining focus on the banks, which obviously are the deposit holders, I think is still extremely important.
Everyone's coming on this. Mr. Crossan, very briefly.
Very briefly. Yeah. Ultimately, the risks always go back to the bank balance sheets. So no matter where it is, the system, it's going to go back to the banks, and so that's why we need to understand the interconnections, but we can't lose sight of the importance of the banks in the system.
Thank you. Julie Minns, MP.
Yes, I just want to turn to household debt. Obviously, we've seen an increase in mortgage rates. What's that doing to household resilience?
So there has been, as you said, there has been an increase by around 75 basis points in mortgage rates since the December FSR. So that has affected a number of households. However, the majority of households had already been through some much higher rate hikes. So by and large, the housing sector, the household sector in aggregate has been resilient despite that rise that we saw. A reason for that is that the aggregate level of indebtedness of the household sector is much lower now than it used to be. However, for some households, it's clear they've been through it's been very challenging, especially lower income households.
And roughly, I think you mentioned a proportion. Just remind us again, what proportion of households would you put in that latter category?
So I think it depends how you reflect it. So for example, you've got a household with a a mortgage and households without a mortgage who are renting. Now, the median income of households who are renting is half of the median income of the household with a mortgage. And those are people who rent are the ones that are most affected by the changes recently. Now, that doesn't affect the resilience of the banking system in any way, but it doesn't mean it isn't an issue.
Definitely an issue for policymakers like ourselves. It's a year since you raised the cap on the proportion of mortgages that banks could lend at on higher income multiples. How's that gone?
It's worked as intended. So we haven't raised the aggregate cap. The aggregate cap is the same. So more than 15% for loan-to-income ratio above 4.5. That aggregate cap hasn't changed. What has changed is that it's no longer applied at an individual lender level. So we have seen, as a result of that greater headroom that has been released, an increase in the amount of high LTI mortgages that have been given. We are now at around 13%, which is higher, and this is the system working as intended.
And negative equity, are you more concerned now than you were a year ago?
We have not seen an aggregate rise in the risk of negative equity. The loan-to-value levels have not changed since what was the case before. That indicates that the new households who have got a mortgage also have savings buffers to compensate for that, but there hasn't been an increase in the negative equity risk.
Okay, I'm going to bring in John Glenn and then Siobhan McDonald MP. Mr. Glenn.
Can I just ask about the gap between the 13% and the 15%? What accounts for that? Because, I mean, you know, there should be more latitude to do more borrowing, right? I mean, and they don't.
Well, it's gone up from lower. It used to be lower. So it used to be 10%. It used
I know
to be
that.
8%. It's going up.
Do you think it will get to 15%? I mean,
it might do at some stage, and there are mechanisms in place to then bring things back down to 15%. But this is the way the tool is set up is on the flow of new mortgages that are granted. Yeah. And this is a means to an end, the end being to control the balance of highly indebted households in the stock of mortgages.
Thank you very much. Siobhan McDonald, Dame Siobhan.
And what proportion of that increase is first-time buyers?
So in aggregate, at that higher level of more than 4.5 LTI, half of those households are first-time buyers.
And given that the 15% is across all lenders, as I understand, given that there is only about 6 companies control 80% of mortgage lending, do the kind of smaller, more innovative building societies who look to assist first-time buyers get a bit battered around by the changes in the borrowing rules of those bigger companies?
So we have had smaller firms also apply for that possibility to leave that. So I wouldn't say so. This has also supported their own ability to extend lending to those higher LTI households, not just.
I don't think we've had small building societies saying they've been squeezed out. I don't pick that up. No.
Okay. Anything else, Dame Siobhan? Thank you. Thank you very much indeed. Jim Dixon, MP.
Thank you, Dame Meg. So just back to the core banking sector and what are the sort of risks that face that sector in terms of your assessment. Would you say it's the geopolitical tensions we've talked about, the AI bubble, exposure to non-banks, or anything else? What would be the sort of the key things that would be on the radar for that sector? Perhaps Governor and then Mr. Benjamin.
Well, I think the big risks I think we face in financial stability at the moment, I think you've sort of covered them, but let me go. I mean, obviously, as we said, and Stephen was saying, market valuations, particularly in the AI sector valuations, leverage in government bond markets, growing leverage in equity markets, frontier AI. I mean, these are the big, I would say, moving parts at the moment that we're looking at. So I think those are the key things. You look at what we're sort of focused on with the banks. I think that's a pretty good description.
The financial stability report talks about banks deploying significant risk transfers.
Yes.
that obviously, taking off their balance sheet some of the risk and into other forms of
securitization. Yes.
Do we think that's a risk? You haven't mentioned it, but
well,
it would appear to be an activity that might threaten stability.
I think it falls into the category. It's not large, but it's growing. Yeah. Now, again, let's go back to the financial crisis. We saw that happen during the financial crisis, and frankly, we got bitten a number of times in that era. And the reason that we got bitten was because we had things that were described as risk transfers, which when push came to shove and the crisis happened, turned out not to be, in the sense that the stuff wasn't actually off balance sheet. It came back. And I think, therefore, we have to, and our PRA look at every one of these when banks come to them wanting to do a risk transfer, and they have to look at the question about, is it robust? Is it robustly transferred? And I think there is some evidence of, frankly, there is some pushing at the margins of this going on at the moment, and that's one of the reasons we highlighted it in the report. Some of this pushing, frankly, is allowed internationally. I have to say we've probably held a somewhat firmer line on this front than has been always the case, I think, internationally. So I'll give you an example. When you're securitizing and the risk is going off to a counterparty, to another party, but you've still got the economic assets, has your relationship with the counterparty been adequately, in a sense, secured? We tend to call it, is it funded? In the sense, have you got pre-positioned assets that will fund it, or are you going on basically a promise from the counterparty? And we are seeing a bit of stretching going on. Not so much here, but elsewhere of the second thing growing. So this falls into the category. It's not the biggest thing, but it's something I think we have to be. We are very alert to.
Do you think
it's growing?
Mr. Benjamin, you want to come in, but do you think there's a big difference between the SRTs and collateral debt obligations that we saw that were a significant part of the financial crisis in 2008? And no matter how good we may be being in our approach to regulation, we all know that the CDO problem actually was most significant in the US jurisdiction, and that brought us down as well. So are we covering that risk in the way in which we're approaching regulation, but also others?
So I would say there's a few differences. I think there are two differences in the fundamentals. One is the banks are stronger now than they used to be. And two is the underlying books of loans have been subject to stricter underwriting standards on average than was the case at the time. So those are two differences in fundamentals. In terms of structure, one of the difference with CDOs that were being traded before is, in the case of a significant risk transfer, is not something that is then being traded. It's a relationship between the bank and the investor. It doesn't detract from the fact that if it's unfunded in particular, it can create some counterparty risk to the bank. And when we talk about lessons learned from the global financial crisis, banks' ability to understand the degree to which they are concentrated to counterparty exposure is a recurring theme. If we look through the list of risk-facing banks that Andrew went through, nearly all of them are channeled through their exposures to the non-bank market-based finance, all of them. So the importance of understanding counterparty concentration is an important lesson to remember from the crisis.
The fourth one I would include that in our stress tests, we do assume these things don't work properly.
Yes.
So,
do you think the banks know enough about what's in those areas that they're transferring risk to have a really good sense of how much risk they're taking?
Well, they have to know how much capital could be really, how much risk is actually transferred for the PRA to actually approve that significant risk transfer. So this is approved one by one by the PRA, so it's different.
And is there anything that you would, obviously the Governor talked about some of the activity appears to be pushing the envelope a little bit. Is there anything you need to do proactively now to rein that in a bit and make sure that we're not exposed to an additional risk?
Well, that is happening. Our colleagues in the PRA have been writing to banks to flag the importance of those, creating that counterparty risk, especially in the case of unfunded transactions.
And it won't be long before you're hearing complaints, I'm sure.
You have broad shoulders, Governor.
Thank you, Damon.
It goes with the territory. John Glenn MP.
Please, could we explore your attitude, policy, mindset towards stable coins? There's been the drop of the proposal to impose a temporary limit on the ownership. You've got the 40 billion issuance, the sort of cap. I wonder if it's viable for anyone to issue with that, what sort of work has been done on that, and if you could also, getting all the questions out up front, what could you characterise the approach you're taking vis-a-vis EU and US, where are we different or similar?
Governor, do you want to start?
So, I think the first thing I would say is just put in slightly broader context. What we want to see in payments is that we get the benefits of digital technology into the payments world, because there are real benefits in terms of smarter contracts. Benefits in fraud, benefits in things like late payments. And we are, I think, open to how that's done. It can be done in stablecoins. It can be done in tokenizing bank deposits, which the banks we're working on the banks with. And we could, introduce central bank digital currency at the retail level. Now, stablecoins are therefore one option. I think it's important that we have rules which enable them to happen, and that's what we've put our proposals out on. On the cap, obviously in our first proposals we said we would cap at the individual account level. I think we got a lot of pushback on that one, frankly. The point we're trying to do is only a temporary transitional thing to say, we have to be careful if there were to be a big shift of deposits out of the banking system as to how we would manage the stability of that. We concluded that the more sensible way to cover that off was an aggregate issuance cap rather than a per account cap, because I think it's much easier for the issuers to manage that. So that's why we've come up with the 40 billion. I get a sense from the response we've had so far that actually the people who are thinking about issuing think that's sort of all doable and workable and quite sensible. So we've had a pretty positive reaction. We made an adjustment to the mix of backing assets. We changed from 60-40, 60 being high quality remunerated, 40 being central bank reserves, which we would not remunerate because our view is they're not then lending on to create credit in the economy, so they're not performing that function, which is important. So there is a big difference with banks there. We felt that looking at it from the point of view of what liquidity these issuers need to have, that 70-30 was fine and doable. We've also provided for the fact that these issuers will have the ability to use, have an account at the Bank of England. They will be a repo facility if they need it. It's not a standing repo facility because, again, they're not banks. But we felt with all of that in place that 70-30 was doable. So again, I think the response so far has been actually good. On the question of where are we versus the rest of the world, I find it's quite funny because we get sort of slightly castigated for being behind. We're actually ahead of the US. You legislated in Parliament sooner than the US has legislated. Yeah. The second bit of US legislation is stuck as far as we can see at the moment, the so-called Clarity. They did the Genius Act, the brilliantly named act. But the Clarity Act is sort of stuck.
Taking credit.
In terms of our rules, some of the US agencies have got their proposed rules out, some haven't. So we're not at all behind, actually, in that sense.
I think the amended proposal makes a lot of sense, and I think the analysis that the bank has done is that the 40 billion issuer cap actually is commercially viable. There are actually issues that we've talked about, is actually that there's an issue about the amount of short-end gilts that are available to actually to serve as backing assets. That's the difference between the UK and the US. That's something that we're obviously talking with the DMO and others about. But I think this is an appropriate change that it's about the pace of adoption of a stablecoin, because if that goes too quickly, then there can be disintermediation.
Okay, and could I, Mr. Krosner, please come in.
On the US, I just want to underscore what the governor said. We did pass the Genius Act last year, but there has continued to be an ongoing discussion about remuneration and whether there will be and in what form remuneration will occur. So we really haven't implemented yet. One of the things that really is quite different about the UK regime is that 30% that has a direct access to the Bank of England, which is, I think, a real differentiator, because one, it allows the bank to monitor on a tick-by-tick basis if money is flowing out very quickly. And so we know that there'll be at least 30% cushion that's there in case there is a so-called run that occurs and that will have it'd be much less likely to have a big disruption in the market because of monitoring that. So I think that's a very important distinction.
And if I could turn to crypto as well, we're told that in the US there are emerging fears that community banks are issuing loans to farmers, and that's threatened by the flow of those funds to crypto assets. Can you make an assessment of what would happen? Could that happen over here? And what the potential is for the growth in crypto assets in terms of the bank's monetary policy and financial policy being rendered less effective in those circumstances? How are you seeing this at the moment?
I mean, I draw a distinction, which I think you'll probably point to as well, between stablecoins and crypto.
Yes.
I think it's important. Stablecoins, I always say, look, they purport to be money, therefore, they need to meet the test of money. But as Nat was saying, access to us means that what goes with us holding them to the standard of money is that we give them also what they need from us to be money. And the absolute fundamental point about money is that it has a short nominal value. So if you're going to use it in payments, you and I know if we're making a payment that my pound is equal to your pound. We don't need to worry about that. Crypto isn't like that. I mean, crypto does not have a short value. That's the key difference. So it's a very different animal in that sense. And the banking...
But that sort of, by stealth, the destabilising effect of higher volumes of crypto in the bank, in the financial system, how do you respond to the...
Well, I mean, on the point of, I don't know precisely what the system is in US community banks. The Basel, I mean, we follow the Basel rules. The Basel rules are very strict. In fact, arguably, many people say too strict on the treatment of crypto. But they do, I think, you fair to say, act to limit banks' holdings of crypto.
That's right. At the moment, the links between the world of crypto and the core of the financial system are not deep at all. We're monitoring that very closely, but the links are not deep.
Yeah. Now, what I do think is, I've heard one or two cases in the US where crypto firms have got banking licenses. I think there's one or two cases I've heard about. So that is not the case here.
No.
Okay.
Thank you very much.
Thank you. Can I thank our witnesses very much indeed for their time. We've had an interesting discussion, a long discussion about the capital rules and banks and whether the balance is right. A lot of discussion about the risks posed by AI and the pace at which this is moving, and the challenge for regulators and firms of keeping up with the risks involved. So there's a lot of food for thought there. And also we discussed the accumulation of investment in AI and whether this is affecting growth in other sectors and what might happen if the bubble bursts, among other interesting topics today. Always an interesting session. So can I thank our witnesses very much indeed. That's the Governor of the Bank of England, Andrew Bailey, Nathaniel Benjamin, who's the Executive Director for Financial Stability and Strategy and Risk at the bank, and the two external members of the Financial Policy Committee, Randall Krosner and Stephen Blythe. The transcript of this session will be available on the website uncorrected in the next couple of days. Thank you to our colleagues at Hansard and thank you to our colleagues at Bowtie for the broadcasting. Order. Order.